Storytelling. Altadena. Same street, same fire. Neighbor A has a private policy with strong replacement cost and living expense benefits. Neighbor B is forced onto the fair plan, lower limits, stricter rules, and actual cash value on parts of the claim. Same disaster. Two radically different futures. In this video, I'll walk you through the decisions they now face. Rebuild with debt, relocate, or fight a utility in court. You'll learn why the payout structure, not just the premium, decides who gets home again in 2026 and who gets stuck in limbo. Before we move on, please take a moment to subscribe to the channel and like the video. You think you're shopping for a monthly bill. Then the flames show up and your good deal turns into a calculator app and a headache. Same street in Altadena. Same firestorm. Two houses that looked like twins last week are now living in different timelines. On one side, the private policy. It reads like a grown-up policy. Replacement cost on the dwelling, extended coverage baked in, and living expense support that doesn't treat you like a couch surfer. Their dwelling limit hits about $1.264 million, which means the rebuild target isn't fantasy math. The claim gets a single adjuster who actually picks up the phone, and the timeline to demo, plans, permits, and framing starts with a funded plan, not IOUS. Across the street, the fair plan. Bare bones fire coverage with tight caps and the cute little quirk called ACV. The dwelling limit sits near $686 grand. Living expenses? A tidy $100,000. That sounds like a lot until you're paying $8 grand a month for a 3-bed rental, plus storage, movers, and the privilege of buying socks again. And here's the catch. Older parts of the home get valued like you're pawning them, not replacing them. Why do two families with the same loss get checks separated by hundreds of thousands? Because one policy pays to rebuild at today's prices, and the other asks how old your roof felt right before it turned to ash. Replacement cost value means fresh materials and current labor rates. Private carriers often stack extended or even guaranteed replacement cost on top. So when lumber spikes or framers add a zero after a disaster, the math still holds. Now watch how the fair plan plays it. The cap is the cap, and ACV? It slices at every line item with depreciation. A 20-year roof with a 25-year life isn't worth much on paper, even if you now need a brand new roof at post-fire prices. Some people bolt on surplus wraparound policies to cover liability or theft, which is helpful for everything not fire. But that add-on doesn't magically turn ACV into RCV. It doesn't grow your ALE either. You still hit the ceiling fast. And here's where it snowballs. After a major event, materials and labor jump. 20, 30, even 40% isn't crazy when the whole region is rebuilding at once. ACV doesn't flex with that surge. RCV tries to keep up. So when an estimate arrives with friendly depreciation on the windows, the HVAC, the plumbing, the cabinets, you feel it. Not because the items were worn out, but because the formula pretends you can replace old with old in a market that only sells new. This is why one family signs a lease nearby and lines up a builder while the debris still smokes, and the other stalls out doing math they never planned to do. The first policy funds time and space. The second rations both until morale improves. So what exactly is ACV doing to your budget, and why does it feel like a trap even before you pour a new slab? Here's the catch. ACV sounds fair until you realize it values your roof like a used couch on Craigslist. You lost a home. The spreadsheet says your roof was mostly done, your HVAC was well loved, and your cabinets were vintage. Cool story. You still have to buy everything brand new at today's prices. Let that sink in. Let's break it down in plain English. Replacement cost value is the new for old deal. It tries to pay what it actually costs to rebuild now. Actual cash value is the garage sale version. It subtracts depreciation for age and wear, then writes the check. Same ashes, wildly different math. Here's where the tension gets weird. A wildfire wipes out every stick of lumber, every wire, every shingle. ACV doesn't care that it all vanished at once. It treats each piece like it was still standing yesterday, aged and tired. So your claim gets itemized into hundreds of little write-downs. Doors, windows, flooring. The system prices your loss like parts, not a house. Now the example you can feel. Say your roof costs $40,000 to replace today, and it's rated for 25 years. Yours was 20 years old. Under ACV, the value might be the 5 years you had left. That's 5/25ths of the cost, around 20%. So maybe you see $8,000 minus your deductible, while the roofer quotes 40. That gap? That's you, a HELOC or a GoFundMe, because the math doesn't blink. And after a major fire, costs jump. Lumber, sheathing, skilled labor, everyone's slammed. A spike of 20 to 40% is common when a whole region rebuilds at once. ACV doesn't flex for surge pricing. It locks to yesterday's value. RCV aims to follow the real bill you'll face, whether that's framing at time and a half or windows back-ordered with a premium. Here's what nobody tells you about the Fair Plan rules until claim day. Certain non-fire perils default to ACV, and even for fire, older components get depressed fast. People buy a wraparound to catch liability and theft, which helps with everything not burning, but it doesn't convert ACV into RCV. The form is the form. The depreciation stays. California does have emergency provisions that can advance a chunk of additional living expenses and some contents money after a declared disaster. Good. That can cover a couple months of rent, food, and basics. But it doesn't flip a switch on how your dwelling payout is calculated. The ACV deduction still carves through your line items. Advances bridge time, not the depreciation gap. So how do you not bleed cash on housing while your depreciated payout barely buys plywood? You control what's controllable. You push for RCV where you can, and you plan around ACV where you can't. Because here's the real takeaway. The difference is structural. RCV funds the future. ACV buys the past at yesterday's price. And it's not just payouts. It's the clock. Where do you live for 12 to 24 months while contractors wait on permits and the rebuild queue moves like DMV on a Friday? If the Fair Plan is a safety net, why does it feel like a trampoline with a hole? You pay in, you fall through, and somehow you're the one patching fabric on the way down. Here's the thing. It was built as last resort coverage for when private carriers ghost your zip code. That sounds noble. The catch is how many of us are stuck on it, not tapping it once and moving on. Enrollment has exploded since 2020 and landed near 452,000 policies by 2024. Let that sink in. While that number shoots up, the coverage stays basic, the premiums aren't bargain bin, and the limits trail what it actually costs to rebuild. It's like buying a gym membership that only lets you use the lobby plants. You're covered, but can you lift anything? Not really. Then there's the wraparound puzzle. You pay more for a second policy to cover non-fire stuff, burst pipes, theft, the random meteor of homeownership. Useful, sure, but it doesn't fix actual cash value deductions on your fire claim, and it doesn't fatten your additional living expenses. It fills gaps around the edges while the main hole in the middle stays open. You're stacking policies like apps on your phone, but the one you need most still throttles your data. Why is this happening? Insurers pulled back from high-risk areas because wildfire risk concentrates and reinsurance got pricier. The math spooked them. Regulators try to coax them back with rate approvals and mitigation plans, but the reset is slow. Meanwhile, your renewal email looks like a breakup text. And the weird part? Who gets dropped and who stays often feels random because the risk models are that opaque. You can clear brush like a pro and still get nudged toward the Fair Plan. Now the human part. You get the Fair Plan check. Do you borrow 6 figures to bridge the depreciation gap? Do you move 2 counties over to find a landlord who'll take a dog and a 6-month construction timeline that is never 6 months? Or do you lawyer up and chase a utility for years while you bounce from rental to rental? None of those are great. All of them cost time, money, and sanity.